Welcome to Talker Tickers, where we break down the earnings calls that matter. Today, we are digging into BankUnited's third quarter results. And this one's interesting, folks. It's a classic case of the market seeing one thing on paper and doing the exact opposite. We're going to figure out why. All right, so here's the deal. BankUnited put out what looks like a classic mixed bag of a quarter. On one hand, you've got a really solid earnings beat. They reported 95 cents per share when the street was only looking for 88. That's a nice 17% jump from last year. But, and there's always a but, right? The top line, the revenue, actually missed. It came in just shy of what analysts wanted to see. So you'd expect the stock to kind of shrug, maybe even dip a little in pre-market trading, and it did. So that brings us to the big question, the whole reason we're digging into this today. Why did the stock completely reverse course and end the day up nearly 2%? What did the market hear on that earnings call that made them totally forget about the revenue miss and start buying? Something flipped the script, and we're going to find out what it was. Okay, here's the game plan. We'll start with those headline numbers, the ones that caused all the initial head scratching. Then we'll get into the good stuff, management's profitability playbook. This is really the heart of the story. From there, we'll look at their guidance for the future, pick apart the key takeaways from the Q&A with analysts, and then we'll wrap it all up with our take on what to expect next. All right, let's get into it. Section 1, the Q3 headline results. Let's look at the numbers behind the narrative. So yeah, the market might have fixated on that revenue miss at first, but these are the numbers that really turn the tide. First up, that bottom line, super strong. They hit 95 cents for EPS, which blew past the consensus by a solid 7 cents. That's not just a small beat. That's a signal that there's some real strength happening under the hood. But honestly, this is the number that really got people's attention. Their net interest margin, or NIM, hit 3%, and they did it a whole quarter earlier than they guided for. You have to understand, for a bank, especially in this kind of environment, hitting that core profitability target early, that's a huge deal. It tells you they are executing big time.
And it's not just about profits. The balance sheet looks like a rock. Their CET1 capital ratio, which is just a fancy way of measuring their financial cushion, grew to 12.5%. That gives them a ton of flexibility to handle whatever the market throws at them.
So you see the picture forming, right? The market looked right past that top-line miss and zoomed in on the quality of these earnings. So let's break down how they pulled this off. What's the playbook here? It really comes down to a super clear three-step strategy that management is just nailing. Step 1, improve their funding mix. Basically, get more cheap money in the door. Step 2, use that better mix to drive down their overall cost of deposits. And step 3, maybe the most important, do all of that without taking on bad risk. Keep that credit quality rock solid.
And this is how they're actually doing it. Look at these moves. They grew their non-interest-bearing deposits, we're talking about checking accounts, basically free money for a bank, by $210 million. At the same time, they got rid of over $500 million in more expensive liabilities and paid down some pricey debt. It's a textbook move. Swap out expensive funding for cheap funding. That's what's fueling that margin expansion, and it just screams discipline.
And the CEO, Raj Singh, he just laid it all out right at the start of the call. He basically said, hey, earnings are up, ROA is up, EPS is up, margin is up, expenses are controlled, credit is flat. I mean, he couldn't have scripted a better quarter. That kind of confident all-around execution, that's exactly what investors wanted to hear, and it's what turned the whole story around. Okay, so they had a great quarter. Awesome. But the million-dollar question is always, can they keep it up? So let's turn to their guidance and see what they're signaling for the road ahead.
First off, their whole outlook is built on the idea that the Fed is going to cut rates a couple of times later this year. With that in mind, they're expecting their net interest margin to stay pretty much flat next quarter, which is a really good sign of stability. They also think they can keep growing those low-cost deposits, the good kind of growth. And get this, they're keeping a tight lid on expenses, saying full-year expense growth will be better than they guided before, coming in around 3%. All right, now for my favorite part of any earnings call, the analyst Q&A. This is where you really get the extra details, and two big topics came up that are crucial for the bank's future. First, of course, was loan growth. With revenue coming in light and total loans basically flat, the analyst jumped on it. They pretty much asked, hey, is this slow growth the new normal for you guys? And management's response was interesting. They didn't deny it. They said, yeah, we've had a lot of loan payoffs. But they also said some of that was on purpose. They're actively getting out of some relationships they don't like. But looking forward, they sounded super optimistic.
They described their new loan pipeline as very, very good and reminded everyone that Q4 is usually their strongest quarter anyway. The message was clear: an inflection point is coming.
Okay, the second hot topic was fee income. And this was a bright spot for sure. Their core fee income grew by a whopping 24% year over year. This is really important because it shows they're finding new ways to make money as they intentionally wind down their old leasing business.
And they were quick to point out that this isn't just some one-time gain. No, this is a strategic push into recurring fee businesses, things like syndication fees, capital markets, stuff that's tied directly to their best commercial clients. And here's the kicker. Management said they're only in the first or the second inning of this strategy. For an investor, hearing that signals there's a huge runway for growth here, a whole new engine for the bottom line.
So let's put it all together. The big picture is pretty clear, right? Management is firing on all cylinders when it comes to profitability. But what does that mean for the stock from here? All right, here's our final take. Look, we think BankUnited is going to deliver another really solid quarter. We're penciling in EPS somewhere between 94 and 97 cents. And as Wall Street really starts to appreciate this profitability story, we see the stock having room to run up and test that $39 to $40 range, which, by the way, is right around its tangible book value. So, our rating, we're calling it a market perform for now. Here's why. They've absolutely proven they can manage margins and control credit. That's baked in. To get an upgrade, to really break out, they have to prove one more thing, that they can get that loan growth engine firing again. That's the catalyst we're all watching for.
And as always, this is not financial advice.